Welcome to this Peters MacGregor update. I'm the head of research, Nathan Bell, and today joining me is Trevor Scott, our senior analyst, who's normally based in Canada. Welcome, Trevor.
Thank you.
So the first thing today, we're going to go through a few of the usual items just as an update, and then we're going to dig into a couple of stocks that we've bought recently. You'll notice the title there of today is Finding Value in World-Class Businesses. So don't be afraid by the image there. We haven't got all your money invested in South America. But I think it's really important to realise that a lot of the popular stocks at the moment, particularly the US technology stocks, are hogging all the headlines. Not only are their share prices going gangbusters, but they are formidable businesses. They're not the type of business that were around in 1999. They're very profitable, but the expectations now are very high as well. And we're actually finding a lot more value away from the US. And the couple of examples we've got today are in Italy, of all places, which has really been a basket case economy for quite a while now. So we are looking for value, as always, but at the moment you'll see there's a real trend, I guess, over the course of this year and last year away from the US, which is where we think the most valuation risk lies at the moment. So I'll just take that disclaimer as read. So just thought it's worth reminding you of what we're trying to do here at Peters MacGregor and what we are. We're a value-focused, high-conviction global equity manager. So we're not trying to own every stock out there. We're just trying to put a portfolio together of 20 to 30 holdings. We're low turnover, so we try to buy right and hang on. We're benchmark unaware, long only, and bottom up. And we've got alignment of staff, and we aim to generate alpha, or to put another way, we aim to beat the index or the market over rolling 5-year periods, and to do so differently. And it's great that we do it differently, but you also have to be right. There's no point being different and wrong. There's two buckets that the types of opportunities we find fall into. The first one is good businesses where the market is overly focused on recent bad news and over discounts this into share prices. So this is your typical value stock, and that's what we're going to talk about later on as our two examples. And the second bucket is highly advantaged businesses whose growth potential is undervalued. So that's probably more like your Tencent, a very fast-growing Chinese technology stock that we might talk about coming up. And so basically, when we've got two quite distinct buckets, that's why you end up with a portfolio of some very fast-growing businesses where we think the growth is going to be faster and more sustainable than the market expects. And we also end up with your more typical value stocks like the banks we own, where you've got very high dividend yields and they trade on very low price-to-book multiples. In terms of our edge, we don't really have an informational edge like a lot of investors used to have in the past. The fact is, in the digital age, everyone has access to a lot of information. And in fact, I think it's a real skill today to actually sift away all the noise and get back to what really matters to each investment case. And there's actually more information out there today than you probably want. But our edge is still thinking long term. The market is short term focused more than ever today. So we think that's still a real advantage. We look for owner managers. We think that's still a reliable indicator, and there's plenty of charts around to show that the outperformance of owner-led or founder-led businesses. And we also look at things like spin-offs and complicated holding structures. So even where a company, we tend to steer clear of companies that have products that are difficult to understand. So biotech stocks where we're not really sure about the sustainability of the pipeline or the coming up drugs. But holding structures that are complicated can be an area where we can really pull them apart, understand them well, and potentially find value. So we're trying to basically put as many of these indicators of our performance in our favour as possible over time. So I'll just move on to performance. The numbers don't look too good there, particularly the last 12 months, and you may think that we've made errors on the stock picking side, and that actually hasn't been the case. It's just that we've been holding a lot of cash through this period. And that 1 year number really shows that we were holding too much cash in that January-February period last year when the market got quite fearful about what was going on in China. And the market's come roaring back since, and we've just essentially been caught short having too much cash. So that's really weighed on the returns. And that's really a theme going back right out to the 3 and 5 years and even to the 7-year numbers. There's been no issues with the stock picking. It's just been the cash drag. So what we've really talked a lot about over the last year or two is making sure that we're continuing to find ideas and we're backing them when we find them because we want to get full value for our research. There's no point finding all these great stocks and then having too little weighting in them. So where are we finding value at the moment? Before I hand over to Trevor, I'll just pick on the European banks. So a year or two ago, we saw Bank of America, which is a very large US bank, had to get through its litigation problems. And once it basically got through that, it was a record fine they had to pay, which was around 17 billion US dollars. Essentially, the bank was nice and clean, but the market didn't really buy into not just Bank of America, but all banks until interest rates finally started going up. The market tends to be very short term. It doesn't like to sit and wait like we do, but we have no inclination about trying to time these things. And so we did quite well out of Bank of America, even though we sold it a bit too early in retrospect. But again, we've basically shifted that money from the US more towards Europe now, where they're about 3 or 4 years behind in terms of cleaning up their banks. So you can see ING Bank there. It's a name that's probably familiar to a lot of Australians. It's got through all of its problems through the GFC. It sold off its insurance business. It doesn't have any of the lingering bad debt problems. And when we bought that about 6 months ago, we were able to buy that at around book value, and it was paying almost 5% dividend yield. And as I said, a very strong and clean bank. So that's the sort of opportunities we've been able to find. But now we've got cases like Italy where, as I'll talk about in a few slides, the government's now putting money into the system, so all the bad debts are starting to get cleaned up, and yet we can still buy them on high dividend yields and at very low valuations. And as the Italian economy starts to improve, we think we're going to do very well out of these banks. But again, we expect it will just be like the US. We don't think investors are going to throw a heap of money behind these ideas until interest rates start going up, just because the market's very short-term focused. And so we're probably around about a year away. There's no telling when Mario Draghi is going to start putting interest rates up, but he has taken a first step and has started to reduce quantitative easing. So that's a first step in the right direction. So I'll hand the Chinese technology stocks over to you, Trevor.
I think the interesting story in the market these days is, as everybody's aware, the North American technology stocks, the FANG stocks, Facebook, Google, Amazon, Netflix, they've done extremely well. And as large components of the index, we have spent a lot of time researching these companies, and we've come to some conclusions that, like Nathan said, these are in no way like the businesses of the tech bubble. They're dominant firms. A number of them are extremely profitable. They're owner-operators with the founders leading the companies, looking out many years, which is generally what we look for. The issue we have is we're having trouble making the valuations work, making sure that we can get the required return on our investment. But the current price, we're just having a lot of trouble with that. But as we do recognize that they're great businesses, what's interesting is we're finding the same business models, but within China, where there's a lot less investor enthusiasm. So if you just look at the Chinese technology stocks on that slide, Baidu is like the Google of China, JD is like the Amazon of China, and Tencent is like the Facebook of China. But what started off as these Chinese companies just trying to replicate what the Western companies were doing, they've moved beyond it in a number of ways. So if you look at Tencent, if you have been to China or if you know somebody that lives in China, you have to have WeChat, which is Tencent's messaging platform. It's like Facebook, but with many other businesses involved with it. So the point is, we think Tencent is an even better business than Facebook and trading at a much more attractive valuation. And just by turning over some stones where people don't normally look, we're coming across these great companies that are trading at attractive valuations. And do you want to talk about the broadband internet?
Yeah, I'll just make one point on Chinese technology stocks. And it's not like we just erred not buying the US technology stocks and just needed to go and make up for that. It's really JD's only been listed for a few years, and Tencent's really come from nowhere over the last 5 or 6 years. But this is the first time in China where we've really seen these founder-led businesses with almost monopolistic positions in their markets, and they're the types of things we look for. So it's not that we've been just not investing in China because we didn't want to. It's just that we need the sorts of businesses and managers that have their own money on the line and that are going to make long-term decisions in the interest of shareholders. And that's what we're really looking for, and that's why we've had this tilt towards China, but also very lucky with Baidu, which is the Google of China. We were able to buy that about a year ago at 12 times free cash flow, whereas Google in the US trades for at least twice that. So you've actually been able to find some value opportunities within a very fast-growing sector. And a company like Tencent is now worth about, has a market value of around $450 million, billion dollars, and it's growing revenues at nearly 50%. So we've just never seen financials like this for such large businesses. It took over 50 years to build Westfield into what it is today, and yet it's only a fraction of the valuation of these companies. So in that sense, it really is a new world, but we're applying the old school value principles to the valuations of these businesses. And so on the left-hand side is our broadband internet providers. So as Trevor coined them recently, is our digital railway companies. So we may not own Facebook and Netflix and Amazon, but all these companies rely very heavily on these internet broadband providers. The industry works very different to what it does in Australia. And over probably the last 40 or 50 years, these companies in the US, for example, have been laying cable in the ground. It's extremely expensive, but just by pure fortune, those same cables that were needed to deliver pay TV in the past are also by far and away the most cost-effective and best way to deliver fast internet broadband speeds to the home. And so what we think is underappreciated at the moment is that people are worried about people switching away from large cable TV bills and just going with things like Netflix or Stan, as we have here in Australia. And people aren't thinking enough about what that means for the internet broadband business. So the incremental revenue to add a customer to the cable TV business is about 35 to 40%. And the reason is you actually have to pay Disney and all the other content providers for the content that they're providing for every customer. With the broadband business, every time you add someone, you don't actually have to pay anything away. All you have to do is just get someone out to drive out and plug them in. And so it's basically, that's all profit. And that's why you don't see that number advertised in any of the company financials. In fact, when you're doing analysis, sometimes it's what you don't see that is the most important thing. And Trevor recognised quite early that after 2011, some of these companies stopped reporting what the profit margins were for the broadband business. And that's the reason why. It's just so profitable. They don't really want any regulatory pressures. And in fact, some changes with the regulatory body in the US are actually very favourable rather than the other way around. So that case, investment case, has done very well for us. Liberty Broadband has worked out very well for us. And we're going to talk about TIM to any Australian investors that might have been burnt by Timbercorp. Don't worry, it's not Timbercorp reimagined. This is a broadband internet provider in Italy called Telecom Italia, and Trevor's going to take you through the detail of that. At this time, I'll also just remind you if you want to type in any questions, and we'll be able to answer them at the end as well. And we've already got a few in. So the portfolio changes over the last reporting quarter. Naspers there is a South African company, but essentially this is just a very cheap way to increase our position in Tencent. If you want a few more details on that, just go straight to our quarterly and I'll take you through that. It's a very simple case. You can see TIM and UBI there. Now we're going to talk about those in detail shortly, so I won't do it here. And we exited a couple of companies. You may remember AIG was a big US insurance company that needed the $185 billion bailout during the GFC. And a new CEO has been brought in there, and he's got reincorporated or reinstituted the old strategy from the former CEO, which didn't work. So we felt like it was fairly valued, and we sold out. And Twitter, we just didn't feel management was as focused on reducing the costs as much as we were, so we decided to move on. And as luck would have it, the stock went up about 8% the next day, but that's value investing for you. So this company here is UBI Banca. About almost probably 18 months ago now, the largest or the second largest bank in Italy called UniCredit raised about 17 billion euros to help repair its balance sheet and get rid of the bad debts. And that was the first time we became really interested in what was going on in Europe, because it was the first sign since the GFC that Europe was finally serious about cleaning up its bad debt problems. We also saw at the same time that Deutsche Bank, the largest bank in Germany, it raised 8 billion euro. And so again, it just seemed like Europe was very serious about cleaning up these bad debts. And so as we continued to look through the sector, and that's part of the reason we bought ING Bank, we then went looking for more banks. And although Italy's economy has been essentially a basket case, it's basically been through a depression since the GFC, with youth unemployment rates about 50%, which is just extremely hard to imagine here in Australia. We saw UniCredit, and I think it was about February, announced that it was selling another 17 billion or 7.5 billion euros worth of bad debts to investors. And then we saw the government come in with 20 billion euros of taxpayer money to help clean up the bad debts. And so UBI Banca and another bank called Intesa San Paolo, it's a very good bank as well, they were basically cherry picking from these other banks that were going to get euthanized by the government. And so they took out all these good loans for themselves, and they raised a little bit of money. So UBI raised $400 million. And to cut a long story short, UBI believes for that $400 million investment, they're going to have an extra profit of 100 million euros in the next 3 years, purely from the cherry picking of the loans from the bankrupt banks that they've been able to do in partnership with the government. And so the last thing we were really looking for was not just the falling bad debts, but you really needed other investors to come in and start scooping up the bad loans. And we've seen that over the last 12 months, where the government takes off the bad loans and sells them off at 20 cents in the euro dollar to investors, and then investors believe they can recoup more than the 20 cents in the dollar as they go about basically reeling in the real estate and selling those properties. And so that process probably should have been started 3 or 4 years ago, like it was in the US, but it's taken this long. That's fine. It's a great opportunity for us. And to give you a sense of the returns we believe we can make here, UBI is still trading at about half times book value and a 3% dividend yield. But you can see the CEO there is a guy called Victor Messiah. Actually worked with Bob Joss at Westpac in the early 90s when Westpac went through its a really bad period that you may remember, where it nearly actually went broke. And so he has a bit of experience cleaning up banks from these positions. And, excuse me, so the story is that he believes that he can actually get return on equity for this bank over the next 2 to 3 years to 10%. Now, with interest rates being so low, that should be a value. I expect the market would put a value on it at least 1.2 times book, maybe 1.3 or higher. And so that's at least 100, 120% return from here if you can achieve that target. Now, that target is slightly reliant on higher interest rates. So at the moment, the European Central Bank interest rate is negative 0.4%, and Messiah is looking for a central bank interest rate of 0.25% to reach that return on equity goal. But even if you can only do 8 or 9%, the upside here just still looks very high for us in an economy that's starting to improve rapidly. Anyone you talk to who's been to Italy recently just talks about how much activity there is. There's signs in the windows looking for people to work in the shops. And so what has been a basket case economy, or a broader area, if you include Greece and Portugal and Spain, is really turning the corner now. So we expect this is going to deliver great returns over the next 2 to 3 years. And again, it just shows you the sort of value you can find once you get away from the US and away from these really popular names. And so with that, I'm going to turn it over to Trevor to talk about Telecom Italia.
Okay, Telecom Italia. The title, Will Italians Pay for High-Speed Internet? It's just following on our existing theme that we picked up in the US about the real story with IT and telecommunications being the massive increase in broadband, especially as video goes online. It's incredibly data intensive. So it's similar to our investment in Charter, which has worked out incredibly well, in the sense that when we went into Charter, people were freaking out about pay TV subscribers. They were cutting the cord and there was less revenue on the TV side. But what we noticed was the more favorable economics of broadband internet, and that was going to more than offset the subscriber losses. So when you look at Telecom Italia, first off, Italy has a horrible internet network. It's even worse than Australia. Italy ranks 55th and Australia ranks 53rd in terms of download speeds. So the Italian population is starved for internet. And why Telecom Italia has been such an underperforming company for years, over the past 17 years, their revenue in nominal terms is down 40%. So in real terms, they've lost half their business. And the reason why it's been so bad until Vivendi and Vincent Bolloré went into the company the past couple of years is Telecom Italia is like most other European telcos. It was a previous government monopoly that relied on your traditional home phone for their revenue. And that monopoly worked really well until the advent of cell phones and the much lower prices that came in the 2000s. So no longer were Italian consumers forced to deal with the government monopoly, they could just get a cell phone and use that as their primary communications device. But what's happened by now, by 2017, again, there's new management that is actually investing in the network. But if you have a home phone that you didn't like before, you thought it was overpriced, you've already gotten rid of that. So the traditional voice subscriber losses is coming to an end. And at the same time, much like Charter, you're starting to see the upgrade to the network flow through in terms of higher internet demand. And this is really why we are invested in Telecom Italia. It's the play on Italians increasing their broadband speeds and being willing to pay up for that. Telecom Italia, until recently, still was pushing out a 5 megabit download service. That's barely even enough to watch Netflix or YouTube on, let alone two people using it at the same time. The Telecom Italia is in the middle of a massive capex upgrade to their network, where it's changing its old copper lines to new fiber lines. And that program is going to end by 2019 with over 95% of the country having access to fiber. And it's only been this year that they're really starting to roll out these new modems that can take advantage of that. And if you look at the sell side estimates on Telecom Italia, they're still factoring in that this company is a melting ice cube. They're not factoring in any of the new broadband subscriber growth that it's actually pushed their quarterly results up. So for the past 5 quarters, Telecom Italia has had positive growth. And this is a massive change from what it's been over the past 2 decades. And the street really hasn't caught on to it. So as you get to 2020, you're going to see the capex decline, the revenue growth, and this stock should very much reweight. It does carry some leverage within it, so it's one of our smaller positions, but we think there's great optionality in the shares today, particularly the savings shares, which trade at a much lower price than the ordinary shares.
So I think this is a really good example of the value that's actually out there if you get away from the big and popular names. So if we get higher interest rates and price to earnings multiples start to compress, for example, this isn't the sort of business or stock that's going to be affected. We've got a great trend here in increasing broadband internet usage, which we've seen all around the world that people are prepared to pay for. And again, it's just from the global perspective, when you've done research in one sector in one part of the world, you can often go and play the same theme in another part of the world. And that's essentially what we're doing here. And a guy called Vincent Bolloré is really important to this investment case. He's called the Carl Icahn of Europe. He's a fast operator. He wants the cost cut. He doesn't take no for an answer. He's a great operator. And it's only really since he's got involved with this company that we've got involved, because there's a lot of fat that needs to be cut out of this business.
I think the other thing in terms of what Vincent Bolloré and Vivendi bring to Telecom Italia is just you're finally having a rational, concentrated management team. So previously, Telecom Italia was controlled by a consortium of Italian banks and the Spanish telecom operator Telefonica. And why that's important is Telecom Italia's second biggest market is Brazil. And within Brazil, one of their direct competitors is Telefonica. So the same company that is on the board is their direct competitors. It creates a massive conflict of interest for the CEO of Telecom Italia, and that's now gone with Vivendi controlling the board. So you're finally actually having a CEO that's incentivized to make the right decision instead of just make sure he keeps his job and not upset the board of Telefonica. So like Nathan said, there's just a lot of low-hanging fruit that this company can execute on.
Yeah, and the Brazilian business could be a source of cash at some point too.
Yep.
And the operating metrics there have been improving rapidly recently, which is also good news. So the last slide there, this is the 3 different ways you can invest with Peters MacGregor. The typical one is the global fund if you've got small amounts, and then if you want something a little bit more bespoke and you've got more money to spend, there's the individually managed accounts and the separately managed accounts. Please feel free to give us a call anytime. We're happy to answer any questions about the portfolio or how you can invest in Peters MacGregor. So with that, we'll go to questions. If you've got any questions, please feel free to submit them now if you haven't already. We've got a few already, so I'll jump in. What do you think about the status of the American market? Is it at the peak as suggested by some pundits? So I think it's pretty clear from the slide deck that we've been shifting the portfolio away from the US. We've still got some companies there that we think offer attractive returns, and they're either misunderstood and therefore undervalued. But if you look at the American market on the whole, anything that's popular, well-known, has well-known growth or pays a decent dividend. All that stuff's trading at nosebleed valuations now, so we're trying to steer well away from that. I pick on McDonald's a lot, even though it's recently hired my son, so I'm actually very happy with the company. But it hasn't grown net profit since the GFC, and yet its price to earnings multiple has increased from 13 during the GFC to about 27 today. So we really want to stay away from those no growth or X growth businesses where you're paying a huge multiple and there's just no margin of safety. And they're the sort of values or companies where we can see them falling by 40% easily and justifying those falls. Whereas with Telecom Italia, for example, trading on 3 times free cash flow, potentially it's very hard to see that falling by 40% and actually justifying the fall. So in that sense, I guess we don't know where the peak is for the US market. There's so much momentum money coming through passive funds. Who knows where it ends, but we are tilting a portfolio away to much more interesting ideas. The second question is, do you see the world market higher or lower by June 18? Likewise, the Australian market. So obviously we don't have a crystal ball and this stuff is very difficult, but what
He's
I would
asking for the crystal ball answer.
But what I would say is that we're actually now sort of 8 years after the GFC in the first synchronized global upswing. I believe in like 30 or 40 years. It's actually something that very rarely happens. So you sort of got this juxtaposition where you've got economies in Europe which are picking up a lot of steam, and yet valuations are already very high because interest rates have been so low for so long. So I'm not sure how that works out for the markets generally. But again, if I just use the second part of that question is likewise for the Australian market, will it be higher? Well, I just look at the banks, for example. The banks are a huge component of the Australian indexes. They're probably trading somewhere near fair value, and if anything happens to the housing market, obviously there's a long way for them to fall. But as long as the confidence is there and people feel reasonably good about the economy, they may go up. Whereas I look at Europe, and the banks aren't as big a part of the market, but they're still fairly large. But we just think on an individual basis, we can do really, really well over the next couple of years as more confidence comes to that sector.
Just want to add, I think the way we look at it in terms of where the market's at next year, of course we have no idea, but the advantage of being a long-term manager such as ourselves is eventually the market will have a big drop, and what's going to happen is you never know when it happens, but you're going to be stuck with the investments you have. And the advantage of being in high quality companies with great management teams is if it takes longer than you expect to be in the investment, that's not a problem because we had already envisioned holding it for many years to begin with. And that's kind of a mistake that I think a lot of short-term managers get stuck with, is they're trying to play something for next quarter or next month, and it doesn't work out, and now you're stuck in the position for a number of years before you can get a proper bid on the stock. So if there was an issue, with the market going down, it's not really going to be a game changer to our original investment thesis.
Well put, Trevor.
Thank you.
I should have got you to answer that question from the start. As another question here is, how are actively managed global equity funds currently performing against ETFs and index funds? And so probably the easiest way to answer this is just to go back to our performance numbers, and basically the ETFs and index funds are essentially in line with our benchmark. So I only tend to look at a few of the handful of managers that have actually done better than that. So some are doing okay at the moment, but there's no doubt that the ETFs and index funds have, because of their exposure to those US technology stocks, also the healthcare sector in the US has been on fire, has very high multiples, and those consumer staples as well, which is a sector we've tended to avoid just because they're very low growth businesses trading on 30 times plus earnings. But they are in the index, they're big components, they're big companies, and so the ETFs and index funds have benefited from that. But I think this is really the time you don't want broad exposure to a large market like the US. It's been a wonderful place to be, an ETF or an index fund. If you bought at the bottom of March 2009, you've enjoyed about a 17% compound annual return for about 8 years now, which is just huge gains over such a long period. And it's now the second longest bull market in US history, which is probably not surprising given the amount of quantitative easing and how low interest rates have been. But now's not the time you want that exposure. It's worked really well in the past, but now you really need to find the undervalued securities. So if there is a shock, you're protected by not only an undervalued security or a cheap price, but also by the quality of the business as well.
I think it's worth mentioning that a huge part of the index, as Nathan said, is just some of these FANG stock names. And as a research investment analyst myself, it would be so easy just to throw these names in. But the whole point of Peters MacGregor in terms of our investment process is after we go through all our filters to identify the right company and right management team, we just have to make sure we're paying the right price, and we can't get comfortable with it. So, the fact that we haven't held some of those incredible names has been a drag, but that is why investors are actively paying us to make these decisions, to make sure that we're doing the right decision long term, even if there's short term periods where it doesn't look that way.
I think many people think when you're going through those downturns like the GFC period in 2009, they're actually the hardest times to invest. But in those times, that's actually, in a sense, it's the easiest time. It's just about picking which opportunities are going to be the best. When you're in these periods as a value investor and everything looks quite expensive, it's much more challenging to find ideas. But I think the beauty, just using, again, the banks as an example in Europe, we might have a synchronized global upturn, but there's actually quite a bit of difference in where the economies are and where some of these industries are at in terms of that recovery. And the US is really where that recovery has worked best. The US economy, share market has offered everything that people want: big, familiar, safe names, fast-growing technology stocks that basically are with monopolistic positions. But now that's all been priced into valuations, and that's what creates the risk. It's not that the businesses themselves are necessarily risky, it's just the valuations offer no margin of safety. And the quote I always remember is that trees don't grow to the sky. Same with a business. It doesn't matter how good it is. If you pay too much, there's no way that business can justify that valuation. So there's going to be at some point a reckoning, and value always matters. And so we're actually quite excited about the portfolio. It's the best looking portfolio since I've been on board at Peters MacGregor. It's the most globally diversified. It's got the best mix of different industries. It's got a huge smattering of owner-operators running these businesses, and they're all in great market positions, and we don't think we're overpaying for them. So that gives us confidence, whatever the markets give us, whatever the macro environment from here, and we feel very confident in the businesses we own, and any opportunities to reload and put the rest of the cash to work or to swap one stock for a cheaper one, we certainly look forward to that. So with that, I say thank you very much for listening. And as always, if you've got any questions whatsoever about your investment or investing with us, please don't hesitate to give us a call. Thanks very much.
Thank you.